Hi there, and welcome back to the Metaverse Stock Exchange. In this video, we're going to analyze what is happening in the markets today, which is they're collapsing. Bank stocks are down huge across the world, especially European banks, and with that, most major indexes, both in Europe as well as in the US, are down by 2-3%. And in the video, we're going to answer first what happened, why are stocks down, and is there a systemic banking crisis in Europe? Because it's very important to understand what happened to Silicon Valley Bank and is this happening in Europe as well? So first and foremost, what happened? There was an interview with the Saudis, which are the biggest investor in Credit Suisse. In Credit Suisse, we can do pretty much a full video on them. They've had problems throughout last year and this year and years prior. So that's bank specific. But they are the biggest investor there, and they were asked, would they put more money in? And the Saudis replied that first, they cannot put more money in because they are a 10% shareholder, and by banking regulations, they cannot be bigger than a 10% shareholder, but as well that there might be other problems. So in the interview, the Saudis reacted like, alongside other problems, there's the regulations that are not giving us the opportunity to invest more money. So it was pretty much obvious at the moment, and the stock started plummeting immediately on those comments because we wanted to know what other problems there are, right? We were expecting that it's only the regulatory problem why they would not put more money in. But those comments pretty much sparked the sell-off. So now the sell-off, as we can see here, is kind of in all banks. Right now, Credit Suisse is down close to 30%. So that's bank specific. But now we're seeing this kind of spread through all our European banks. BNP Paribas is down 11%. Then Bilbao is down 9%. Banco Santander is down over 8%. And then Societe Generale is also down 12%. So you can see that it's broad sell-off and it is pretty big declines. And to first understand these declines, we have to put this in context, and that's why I'm making this video. So this is a 1-year chart of these exact banks, as you can see here. And even though these are drastic declines on a 1-day basis, if we're looking at a 1-year basis, what you're going to see is that 3 of the 5 banks are positive, and the only negative besides credits, we said it has bank specific problems, is Societe Generale, and it's pretty much down just let's say 6 to 7%. Why is this important? Pretty much today's decline, otherwise it was positive on the year. Keep in mind that last year all stocks were down. Major indices in the United States were down by the Dow Jones 10%, S&P 20%, the Nasdaq 30%, while these stocks performed really, really good, pretty much being positive. So keep in mind that these bank stocks outperformed the market. And as you can see here, in the last 2 months, they have significantly outperformed. And what we're seeing now is just giving up these kind of outsized gains for the past 2 months. As you can see, even on a 3-month basis, most of these stocks are higher than what they were trading 3 months ago. So when you're looking at these numbers, and I believe the media is pushing this narrative, oh my God, it's a banking crisis and a collapse because of these outsized 1-day moves. But if you go backward and see that these banks are really trading at prices that are even higher than a couple of months ago, you're going to get the full context that it does not seem like as bad as it looks on a 1-day chart. So that's kind of analyzing the stock price. Now, if we look at bank specifics, and we're going to analyze the balance sheets, and we're going to look at SVB's balance sheets, which is Silicon Valley Bank, and then I have Societe Generale and Banco Santander here for you to understand why I believe the European banks are much safer from what happened to Silicon Valley Bank. So Silicon Valley Bank, the problem was they had outsized losses in their treasury portfolio. But why is that important? If we look at their balance sheet, so they had around $200 billion in total assets. What you're going to see, they had close to 130 billion of those into investments. And yes, there's other different types of investments, including the treasuries. but 130 of that in investments and only 70 in loans. So they were pretty much 2 to 1 exposed to market volatility in investments compared to loans. Why is that important? Because European banks are not set up this way. Societe Generale, which is pretty much the highest exposed, and that's why we're seeing kind of the biggest kind of decline today in the down performance here compared to these other banks, is because they do have a lot of exposure to investments. So it's over 400. But again, comparing that to the loan departments, we had 570 in loans compared to 420 in investments. So even though they had a lot of exposure to markets, still their core, the vast majority of their assets is in loans. So that's why they have a lot smaller exposure to markets and especially to the treasuries and what is happening to bond prices. And this is the kind of best example for, let's say, the crisis case. If we look to Banco Santander, what we're going to see is that they have investments 320, but they have loans of 1,000. So pretty much a 3 to 1 ratio of loans compared to investments. So the vast majority of their assets or their money put to work is in loans, is not in investments, and it is not in treasuries or other marketable assets. So they don't have that exposure. So that's why I believe that there is not as big of a threat as the market seems like, especially kind of this outsized move. And I think most of it is based because of Credit Suisse in their exposure maybe to Credit Suisse, which brings us to the last question, what if Credit Suisse kind of fails? Will that bring down these other banks? In my question to that, I think the Federal Reserve in history answered this question is that all of these banks are pretty much kind of set in stone by this point, too big to fail. If the Federal Reserve and the US Treasury didn't allow Silicon Valley Bank to fail, then I don't see any world where, whether it's France or Switzerland or Spain or even Germany with Deutsche Bank, that they're going to let one of their biggest banks fail. So even if push comes to shove and Credit Suisse has huge problems, I believe that the governments will kind of interject and save the day, pretty much similarly to what happened in the United States. And that's why I believe that although there is problems in the banking sector, obviously there has always been, they are too big to fail because they're crucial to the entire economy. And if push comes to shove, that the governments will step in. And I was looking at kind of that even the European Central Bank has access to some lines to the Federal Reserve. So if they need to pull money from the Federal Reserve to save European banks, they can do that. So the pretty much infinite money printer is on, and if there is a systemic problem, there will definitely apply it and save these banks. Now, whether that will lead to inflation and other problems, that's a different conversation. But these outsized moves, I wanted to make this video for you to understand that they're not as big of a deal as they might seem like, because banks had a huge run up. They're just giving up that run up today, and because it is a bank specific problem, not a system specific problem. And even if it is, there's ways for the governments to step in. And again, looking at the balance sheets, we can see that these banks do not have such exposure to markets as Silicon Valley Bank or some other US banks that had a lot of their money in treasuries. So hopefully this helps you understand what is happening, and I will see you in the next video.